Ind AS 21, the effects of changes in foreign exchange rates. What is the objective of Ind AS 21? Objective of Ind AS 21 includes transactions in foreign currencies, translation of financial statements into a presentation currency, foreign operations, translation of financial statements, foreign operation. Ind AS 21 does not apply to derivative transactions and balances covered by Ind AS 109, but the standard applies to translation of amounts relating to derivatives from functional currency to presentation currency, hedge accounting, presentation of cash flows from transactions in a foreign currency or to the translations of a cash flows of a foreign operation into the statement of cash flows, long-term foreign currency items for which an entity has opted for the exemption as per Ind AS 101. Such an entity may continue to apply the accounting policy has opted for such long-term foreign currency monetary items. Types of currencies. Currencies are of three types: foreign currency, functional currency, presentation currency. Foreign currency. Foreign currency means a currency other than the functional currency of the entity. Functional currency. It is the currency of the primary economic environment in which the entity operates. Presentation currency. It is the currency in which financial statements are presented. Primary economic environment. Primary economic environment is normally be the one in which it primarily generates and expends cash. The functional currency is normally the currency of the country in which the entity is located. It might, however, be a different currency. Presentation currency may be different from entity's functional currency. Functional currency. An entity measures its assets, liabilities, equity, income, and expenses in its functional currency. All transactions in currencies other than functional currencies are foreign currency transactions. There are certain indicators for determining the functional currency. First one, primary indicators. Second, secondary indicators. First, primary indicators. Functional currency is the currency that mainly influences sales prices for its goods and services. This will often be the currency in which sales prices are denominated and settled, and of the country whose competitive forces and regulations mainly determine the sale price of its goods and services, or the currency that mainly influences labor, material, and other costs of providing goods and services. This will often be the currency in which these costs are denominated and settled. Other factors that may provide supporting evidence to determine an entity's functional currency are secondary indicators. The currency in which funds from financing activities, that is, issuing debt and equity instruments, are generated, and the currency in which receipts from operating activities are usually retained, that is the functional currency. When the above indicators are mixed and the functional currency is not obvious, the management will be required to use its judgment to determine the functional currency. Management has to give priority to primary indicators before considering the other indicators. Next, accounting for foreign currency transactions. A foreign currency transaction is a transaction that is denominated or requires settlement in a foreign currency. Foreign currency means a currency other than functional currency of the entity, including transactions arising when an entity buys or sells goods or services whose price is denominated in a foreign currency, borrows or lends funds with amounts denominated in a foreign currency, or otherwise acquires or disposes of assets or incurs or settles liabilities denominated in a foreign currency. Initial recognition at the transaction date. A foreign currency transaction is initially recorded by translation in the entity's functional currency at the exchange rate on the transaction date. For practical reasons, an average rate for a week or a month might be used for all transactions in each foreign currency occurring during the period. However, if exchange rates fluctuates significantly, the use of average rate for a period is inappropriate. What is the difference between monetary items and non-monetary items? Monetary items. Right to receive a fixed or determinable number of units of currency exist in case of monetary items. Examples of monetary items: pensions and other employee benefits to be paid in cash, provisions that are to be settled in cash, lease liabilities, cash dividends that are recognized as a liability. Most debt securities are considered as monetary items because their contractual cash flows are fixed or determinable. Non-monetary items. There is no right to receive fixed or determinable number of units of currency in case of non-monetary items. Examples of non-monetary items are prepaid expenses or incomes received in advance on the basis that no money will be paid or received in the future. Goodwill, intangible assets, inventories, PPE, right of use assets, and provisions that are to be settled by the delivery of a non-monetary asset. Subsequent recognition at the end of reporting period. At the reporting date, assets and liabilities denominated in a foreign currency are translated as follows. Subsequent measurement. In case of monetary items, they should be translated at exchange rate as of the reporting date, that is closing rate. In case of non-monetary items measured at historical cost, they remain at the exchange rate as on the date of transaction. In case of non-monetary items measured at fair value, they will be translated at exchange rate as on the date of fair value was determined. In some cases, the carrying amount of the items is determined by comparing two or more amounts. Example, inventories, they will be measured at lower of cost or NRV, whichever is lower. Next, assets subject to impairment loss, lower of assets carrying amount and its recoverable amount. If such an asset is non-monetary and measured in a foreign currency, the carrying amount is determined by comparing the cost or carrying amount as appropriate, translated at the exchange rate at the date when that amount was determined. That is the rate at the date of the transaction for an item measured in terms of historical cost and the net realizable value or recoverable amount as appropriate, translated at the exchange rate at the date when that value was determined. Example, the closing rate at the end of the reporting period. The above may result in an impairment loss being recognized in the functional currency but not in the foreign currency or vice versa. For example, a foreign currency asset amounting to euros 2 lakhs is recorded at the date of purchase when the exchange rate was 52. So the amount will be 2 lakhs into 52, which comes to 104 lakhs. The recoverable amount of an asset as on the reporting date is calculated at euro 1,75,000. The exchange rate as on the date of valuation was rupees 60 to a euro. The carrying value of the foreign currency asset will be determined based on the recoverable amount of the asset converted into functional currency and the exchange rate on valuation date, which is 105 lakhs. The impairment loss of euros 25,000 in foreign currency is not recognized here. Next, recognition of foreign exchange gains and losses in case of monetary items, in case of non-monetary items. In case of monetary items, exchange differences arising on monetary items are recognized in profit or loss, except for monetary items that in substance form part of the reporting entity's net investment in a foreign operation. Non-monetary items. Ind AS requires certain gains and losses to be recognized in other comprehensive income. For example, a revaluation gain or loss on PPE is recognized in other comprehensive income as per Ind AS 16. If the gain or loss on an non-monetary item is recognized in other comprehensive income, any exchange component of that gain or loss is also recognized in other comprehensive income. If the gain or loss on a non-monetary item is recognized in profit or loss, any exchange component of that gain or loss is also recognized in profit or loss. Change in functional currency. Once an entity has determined its functional currency, it is not changed unless there is a change in the relevant underlying transactions, events, and conditions. If circumstances change and a change in functional currency is appropriate, then the change is accounted for prospectively from the date of the change. For accounting the effect of a change in functional currency, all items are translated into the new functional currency using the exchange rate at the date of the change. The resulting translated amounts for non-monetary items are treated as their historical cost. Next, use of presentation currency other than functional currency. Translation of financial statements to the presentation currency. An entity may decide to present its financial statements in a currency or currencies other than its functional currency. If presentation currency differs from the entity's functional currency, it translates its financial statements into presentation currency. The financial statements are translated into presentation currency as follows. Assets and liabilities for each balance sheet presented, including comparatives, are translated at the closing rate at the date of that balance sheet. Income and expenses are translated at exchange rate at the date of the relevant transactions. Average rates for the period, if often used, if they are a reasonable approximation. Treatment of exchange difference on translation. All resulting exchange difference should be recognized in OCI and are presented in a separate component of equity, generally referred to as the foreign currency translation reserve or currency translation adjustment. The choice of presentation currency represents an accounting policy, and any change should be applied retrospectively in accordance with Ind AS 8 unless impracticable. This means this means that the change should be treated as if the new presentation currency had always been the entity's presentation currency, with the comparative amounts being restated into the new presentation currency. Foreign operation. Foreign operation has been defined as an entity that is a subsidiary, associate, joint venture, or branch of a reporting entity, the activities of which are based or conducted in a country or a currency other than those of reporting entity. Functional currency of foreign operation. Additional factors are set out in the standard to determine whether it is functional currency, whether its functional currency is the same as that of the reporting entity. First one, functional currency of foreign operation. How activities of foreign operation are carried out. Is it an extension of a reporting entity? Functional currency of foreign operation may be same as a reporting entity. If activities of foreign operation are carried out with a significant degree of autonomy, functional currency of foreign operation may not be same as a reporting entity. Next, foreign operation proportion of transactions with reporting entity are high, then functional currency of foreign operation may be same as a reporting entity. Foreign operation proportional of transactions are with the reporting entity are low, then functional currency of foreign operation may not be same as a reporting entity. Whether cash flows from operating activities of foreign operation directly affect cash flows of the reporting entity and are readily available for remittance to it. If it is yes, then functional currency of the foreign operation may be same as a reporting entity. If it is no, functional currency of the foreign operation may not be same as reporting entity. Whether cash flows from activities of foreign operation are enough to pay its own debt without asking for funds from reporting entity, then functional currency of foreign operation may not be same as reporting entity. If it is no, functional currency of the foreign operation may be same as reporting entity. The above factors also demonstrate whether the entity is integral to the reporting entity or not. Translation of foreign operations. The guidance provided on determining an entity's functional currency equally applies to determining the functional currency of a foreign operation of the entity. Effectively, the translation procedures for translating foreign operations are the same as those followed when an entity presents its financial statements in a presentation currency that is different from its functional currency. When the exchange difference relates to a foreign operation that is consolidated but not wholly owned, accumulated exchange differences arising from translation and attributable to non-controlling interest are allocated to and recognized as a part of non-controlling interest in the consolidated balance sheet. Next, intragroup transactions. Intragroup transactions between a reporting entity and foreign operation may include sale or purchase of goods or services on credit, resulting in trade receivables and trade payables, or long-term loan given by parent to subsidiary, resulting in loan given and loan taken. Although intragroup balances are eliminated on consolidation, any related foreign exchange gains or losses will not be eliminated. Next, net investment in foreign operation. A monetary item receivable from are payable to a foreign operation may result in the following two cases. Settlement of such monetary item is planned in the foreseeable future, or settlement of the monetary item is neither planned nor likely to occur in the foreseeable future. Example, such monetary items may include long-term receivables or loans, but does not include trade receivables or trade payables, where the settlement is neither planned nor likely to occur in the foreseeable future. It shall it has the same economic effect as that of the capital contribution and may form part of net investment in a foreign operation. A long-term loan does not automatically qualify to be treated as net investment simply because it is of a long duration, unless management has expressed its intention that repayment is not foreseeable. In the absence of management's intention, it implies that its settlement is planned in the foreseeable future. What is the treatment of exchange difference of intragroup transactions in SFS, RIFS, or CFS, where the settlement is neither planned nor likely to occur in the foreseeable future? It forms part of the reporting entity's net investment in a foreign operation. Treatment of exchange difference in SFS. Such exchange difference are recognized in P&L in the SFS of a reporting entity and are the individual financial statements of the foreign operation as appropriate. Treatment of exchange difference in CFS. Such exchange difference are recognized initially in OCI, other comprehensive income, and then reclassified from equity to P&L on disposal of the net investment. Whether the settlement is likely to occur in the foreseeable future. Treatment of exchange difference in SFS. Treatment in SFS is same, remains the same. Treatment of exchange difference in CFS. In CFS, such exchange difference will be transferred to consolidated P&L and not OCI. Example, parent P has US dollars as its functional currency and subsidiary S has euro as its functional currency. P, whose reporting date is 31st March, lends US dollar 100 to S on 30th September 2021. S converted the loan amount received into euros on receipt. Exchange rate as on 30th September 2001 is $1 equals to 1.5 euros. Exchange rate as on 31st March 2022 is $1 equals to 2 euros. Entries in the books of accounts of S. Date, particulars, debit, credit. On 30th September 2001, to recognize the intragroup loan will be $100 into 1.5. Entry will be cash or bank account debit to intragroup payable account 150 euros. On 31st March 2022, there will be exchange loss of 50. The entry will be exchange loss account debit to intragroup payable account 50 to recognize exchange loss on intragroup loan. In S second entry, the liability is remeasured at 31st March 2022 and the translation loss is recorded. Entries in the books of accounts of P on 30th September 2001 to recognize intragroup loan on issue. Entry will be intragroup receivable account debit to cash or bank $100. On consolidation as at 31st March 2022, the receivables and payables in respect of intragroup receivables and payables will be eliminated. However, an exchange loss equivalent to Euro 50 will be recognized in USD in CFS for the year ended 31st March 2022 and will remain on consolidation. This is appropriate because S will need to obtain USD in order to repay the liability. Therefore, the group has a foreign currency exposure. The exchange loss will be taken to consolidated P&L unless the loan forms part of P's net investment in S, in which case it will be transferred to other comprehensive income at the time of consolidation. Next, goodwill and fair value adjustments arising from a business combination. Any goodwill and any fair value adjustments to the carrying amounts of assets and liabilities arising on a foreign operations acquisition are treated as assets and liabilities of the foreign operation. Hence, they are expressed in foreign currency of the foreign operation and should be translated at the closing exchange rate, as is the case for other assets and liabilities. Next, disposal or partial disposal of foreign operations. In case of full disposal, on disposal of foreign operations other than subsidiary, the cumulative exchange differences relating to the foreign operation previously recognized in OCI and accumulated in equity are reclassified from equity to P&L. Reclassification adjustment. On disposal of a foreign operation, that is the subsidiary, that is loss of control, the cumulative exchange difference of parent share previously recognized in OCI and accumulated in equity will be reclassified. But the cumulative amount of the exchange differences that have been attributed to the non-controlling interest is derecognized, but it is not reclassified to P&L. Even if the disposal in a subsidiary is partial, but it results in loss of control, same treatment applies as discussed above. Example, parent P owns 100% of the foreign subsidiary S. P sells 70% of its investment and loses control of S. The entire balance in the foreign currency translation reserve in respect of C is reclassified to P&L. Next, partial disposal. On partial disposal of a foreign operation, that is a subsidiary without loss of control. In this case, the entity reattributes the proportionate share of cumulative amount of the exchange difference recognized in OCI to the NCI in that foreign operation. For example, parent P owns 100% of the foreign subsidiary S. P sells 10% of its investment and retains control over S. Therefore, 10% of the balance in the foreign currency translation reserve is reclassified to NCI. Next, on partial disposal of the foreign operation other than subsidiary, the entity reclassifies to P&L only the proportionate share of the cumulative amount of the exchange difference recognized in OCI. For example, parent P owns 35% of the foreign associate B. P sells a 5% stake and retains significant influence over B. Therefore, 1/7, that is 5 by 35th of the balance in the foreign currency translation reserve is reclassified to P&L. A written down of the carrying amount of the foreign operation, either because of its own losses or because of an impairment recognized by the investor, does not constitute a partial disposal. Accordingly, no part of the foreign exchange gain or loss recognized in the OCI is reclassified to P&L at the time of written down. Next, difference in reporting dates. When there is a difference in the year end of the foreign operation and that of the reporting entity, the foreign operation often prepares additional statements as of the same date as the reporting entity's financial statements. When such financial statements are not prepared, Ind AS 110 allows the use of a different date, provided that the difference is no greater than 3 months. That means maximum difference in dates allowed is 3 months. And adjustments are made for the effects of any significant transactions or other events that occur between different dates. In such a case, the assets and liabilities of the foreign operation are translated at the exchange rate at the end of the reporting period of the foreign operations. Adjustments are made for significant changes in the exchange rates up to the end of the reporting period of the reporting entity in accordance with Ind AS 110. A similar approach is used in applying the equity method to associates and joint ventures in accordance with Ind AS 28, investment in associates and joint ventures. Tax effect of all exchange differences. Ind AS 12, income taxes applies to tax effects of gains and losses on foreign currency transactions and exchange differences arising on translating the results and financial position of an entity, including foreign operation, into a different currency.